Hello and welcome to Options Guide TV. My name is Brian Overby. I am the author of the Options Playbook, and I'll be your host for about the next 30 minutes here on Options Guide TV. Today's date is Wednesday, April 10th, 2024. We got CPI numbers today, and they were hotter than expected. So because of that, we've seen a tankage of the markets. S&P 500 index right now is down around 1%. Saw the 10-year Treasury yield take a big jump up to about 4.5%. We saw oil actually spike a little bit, pushing $90 a barrel. So the markets are not happy. The Fed is going to be releasing their March meeting notes here shortly, and the probability of a rate cut going out to June. Now, remember, everybody's kind of ignoring what's going to be going on in the next Fed meeting. But if I take a quick peek at June, it's unexpectedly looking like a little bit of a rise up in that probability based off of the futures over the last week. And that's still, this is live numbers that when you look at the CME Fed Watch tool, and they're saying that there's about a 57% chance of a rate cut. So interesting dynamic. Kind of expected that those probabilities would go down, but the monies are what the monies are. And they're saying that there is a 57% chance of a rate cut in that June Fed meeting. Now, what does that do to our trades? We have earnings that are coming up, so we're getting back into another earnings season. Usually the financials are the big stocks that really kick it off. JP Morgan is the leader in the financials. And then a lot of other banks will follow. So we do have some positions that we need to tweak. In particular, we have a Charles Schwab position that we need to look at inside our paper trading account. But not to get ahead of ourselves, let's look at what we put on Monday's show, which was a skip strike butterfly in the S&P 500 index. And if we even look at the VIX today, and I guess this is not real surprising. We do have a 1% down day, which is that's a very solid down day in the S&P 500 index. And I'm going to highlight that right now. So let's show the TradeHawk software, and I'm going to highlight that we are down 1%, but the VIX is only up about 5%, or basically 80 cents, which is nothing. And that's mainly because running into this print, we saw a fairly big spike in implied volatility. And that did affect our skip strike butterfly, trying to get that trade on. We got it off for a 25-cent net credit. I wasn't too happy about that on the show. The market actually kind of moved against us during the show while I had it set up. And that's, one of the things about doing live trades on Options Guide TV using live data. It makes the show interesting, but it also can be a little bit of a pain in the rear when the markets do move, when you have a perfectly fine trade all set up to go. So that trade's going to work out. It turned out to be a real good trade. In other words, we did it as an alternative to selling a short spread in the SPX, and we ended up doing a skip strike butterfly, and we brought in a credit right around 25 cents. When we started, it was 35 pushing 40. By the end of the show, it was trading right around 25 cents, and we had a $1,500 requirement. So it looks like these option contracts are going to expire worthless. You never know in the world of option trading, but that may happen. So I'm going to adjust today just so that we have something to talk about on Friday. And we're going to go down on the downside, and we're going to see if this trend stays alive. And we're going to look at adding a calendar spread with only a few days remaining. We did one of these before, a little bit feeding off of the show that I had with Dan Sheridan. That's kind of their favorite trade on the downside. We could look at a butterfly, but I think I want to look at the actual calendar spread. But I want to do something to the downside to try to see this type of or try to ride the momentum or the wave that the CPI report has started. So Here's where the market is at. Let's look at our skip strike butterfly. We had nice round numbers on it, and there's not going to be much there to look at. Now, there's still potential that the market could come back, and we're on Wednesday, so there's really not a lot of nervousness about this trade, and we would definitely let it ride till that expiration date. But in the S&P 500 index, we looked at the buying the 5,300, selling the 53.15, and then skipping the 53.30, and then buying the 53.45. Okay, so 5,300, we're going to buy that. We're going to sell two of the 52.15s, skip the 30, and buy the 45. All right. So now it's showing a midpoint of 8 cents. We put it on for about 25 cents. But more importantly, it's way down on the scale. So we are up on the trade. Because we have the hedge on, because we have, as opposed to doing the short call spread outright, where you just have risk, right, on the short call spread. If you did the short call spread, you would have pulled off about 80 cents on the trade because we did apples to apples or apples to oranges comparison. The short spread and the net credit received versus the skip strike butterfly and net credit received. So we were looking at about 80 cents on the short spread. On the skip strike butterfly, we were looking at about 25 cents. So in the short spread, if I could buy it back for 5 cents, I would be very tempted to do it. In the skip strike butterfly, I'm not that worried about it because if the market does start coming back, we actually have a lot of upside in it if it comes anywhere near the 5,300. And we're on Wednesday, got all day Thursday, all day Friday. So you kind of hope the market actually starts coming back as far as that position is concerned. So I'm going to send this to the what if calculator, and let's inside the Trading Hawk software, one of my favorite pages is the what if calculator. And let's zoom in a little bit on this. And we see now the market is all the way down here, 51.60. When we did the trade, it was 52.13. So we're down quite a bit. We were up in this range when the trade was put on, and now we are down at 51.60. But here's where our profit and loss graph gets interesting, right? So if it just stays here, we can make that 25 cents. It's showing it as of today right now, which would only be about 8 cents if we got the trade off right now. But as this approaches, here we go, higher and higher. As expiration approaches, this eventually is going to morph that direction, and let's show it. Okay, so this is the profit and loss graph as of real-time data right now at 11 o'clock Eastern time. We go to Thursday, and that changes quite a bit. And then we go Friday at 11 o'clock, last day, and boom, all of a sudden you see a lot of profitability within this range. And then obviously from 11 o'clock to 4 p.m. Eastern time, we see the markets will skyrocket, and this line morphs into the profit and loss graph. So there's a lot of benefit to staying below our first strike, which is the 5,300 strike, going into Friday. There's a lot of benefit there, just a lot of nervousness goes away if the market will stay below that. But then on Friday, we wanted to start drifting that way. So it's a very interesting trade. I wanted to get a little bit better credit for the trade. Probably should have adjusted it a little bit more to the downside, but we were live on the show and we just kind of rode with it the way that it was. So let's add to this position. Let's make this week interesting now that this trade is going to expire worthless. We're going to make our 25 cents. Our requirement was $15 or $1,500 for every 1x2x1 butterfly that we put on. That would have been the very similar to the short spread that we were looking at. I think we were looking at a 10-point wide short spread though. That would have been about $1,000, or that would have been $1,000 in margin requirement to put that trade on. Now you can do these trades in IRA accounts as long as you're approved for them within the Trade Hawk and Tradier platforms. You can actually trade advanced option trades as long as they are limited risk, like the short call spread and the skip strike butterfly, where that risk is defined. And what do I mean by defined? Well, if we go back to the what if calculator, this is defined. We know what the maximum loss could be on this trade. And because we have this hard line right here at expiration, that is a defined risk trade, and that is possible to do that trade inside the any retirement accounts or any account within Tradier if you have the level of approval to do those option trades. All right. So let's wipe this out. And we're just let's close it this way. And then we're going to go down and we're going to work on this together here. We have only 2 more days remaining. There's a lot that's going to happen on this skip strike butterfly on this calendar spread that we're looking at. And only because there's just so much time decay that happens from Wednesday to Friday in the S&P 500 index. And we kind of showed that just by looking at the what if calculator. You see how much those profit and loss graphs jump every 24-hour period that we leaped forward in our profit and loss calculator. So if we go here and we see the April 2nd date, want to make sure that we have that right. We're looking at this expiration right here. We're going to go down to this area. Let's go and look at the 1 standard deviation move, which is highlighted inside the TradeHawk options grid. And we see that that's fairly close to where it is because the delta, just to confirm, should be right around 16, implying there's a 16% chance that the market could finish 1 cent in the money down around this range. And so we're going to stay within that range. So you're talking about a 60-point move, another 1% move to the downside. We want this one to have a chance. So I think what we're going to do is we're going to sell this option contract. And I think we're going to look at the April 16th expiration. So this is the one that we want time decay to happen, that we want the market to go towards. And then we're going to go to, here's the April 12th. And so then we're going to look at the 16th, which gives us the entire weekend. And we're going to buy that 50.90 and see how much we get. Oh, man. Oh, 50.90. Yeah, that doesn't make sense. 15. Okay, so that's going to be a little bit too expensive if we buy this one. 650. I'd like to get her down around $4 or $5, something a little bit more manageable. So let's look at the 15th expiration and keeping it right there. All right, 50.90. Let's remove this one on the 16th and let's look at this one. $12. All right, that's a little better. Okay, so now we're $3.60. Okay, so we're just going to have the weekend for the rate of time decay, but we're going to do a very short term. This is going to be the paper trade for the week, and we're going to spend $360. We're hoping that the markets start to go down in this direction. We want time decay to happen on the April 12th option contract. Scroll down to here, which is right there. We want this one to wither away and the market to go this way. And as that happens, we're hoping implied volatility stays where it's at or increases. That would be a good thing, because if this option contract expires worthless, we want to be long this option contract and we want implied volatility to increase. So this is the way that we're going to approach it. We're going to have a short-term trade on this, $3.60. If the market does bounce back and starts going to the upside, we'll have to look at an adjustment. We'd have to probably adjust it on Thursday before the Friday expiration. That we're still going to have some juice in those option contracts if we have at least 1 day remaining in these option contracts. So on the upside with our skip strike butterfly, we're just going to let that ride. We're going to watch this. This will be our paper trade for the short term, is our calendar spread, or i.e. time spread to the downside. Now, I mentioned a butterfly. So let's look at what a butterfly alternative would be. It's going to be a little bit cheaper, but this will have a full day until that expiration date. So it'll be a much different trade. Let's center it around the 50.90. This will be our official paper trade that we're going to work on for the week. And let's go back to the Friday expiration here. And I really wouldn't want to do a skip strike in this instance. I just want to have limited risk, and it will be a lower price trade to put on. So let's remove these. We're going to go 1590, and let's go. We stayed 15 points wide. That might be a little bit. Let's go 15 points wide. 75, 80. Let's go here. We're going to buy this. And I froze up a little bit. There we go. Buy the 75. We're going to sell 2 of the 90s. And then we're going to do the 505. And we're going to buy that one. All right. I guess we're going to have to go 10. Well, let's see. 1 by 2 by 1. I need the market to adjust here. $0.60 midpoint on that trade, so a lot less risk overall. Let's screenshot this, and this is the one that we're going to look at. So we brought in, looks like we're going to make 25 cents on our skip strike butterfly. This is going to be 65 cents, means we got 45 cents of risk if we end up doing this butterfly. And we'll look at how this trade pans out and the actual risk relative to the calendar spread that we did. And that's where we're going to leave that. All right, 65 cents. Yeah, and it looks like it's staying right there. So not bad. So looking for a move down to 5105, somewhere landing between 5105 and 5190. Don't mind this trade at all. We'll see where that ends up at a 65 cent. And the reason why this is fairly inexpensive is that this VIX is staying high. Right up around that 60%. When implied volatilities are higher, butterflies are cheaper. As implied volatilities come down, butterflies become more expensive. If you're correct on your forecast, you want implied volatility to go in because you have to buy 2 of the 50/90s in that instance. All right. So if you have any comments or you would like to talk about any of these trades that we have lined up this week, any of these paper trades, please, if you're in the Tradier YouTube platform, you can put it in the chat box and I'd be happy to address those trades. Any of the questions that you may have. And if not, what I do want to kind of focus on a little bit more today is we had Amazon actually hit an all-time high. It actually came really close. Let's see if we actually got there in that. Yeah, we came all the way up. So it's definitely a most recent high. Let's go back a few. Let's go back days. And this is, look at how close we came to that. It doesn't look like we quite broke out from that new, this is going all the way back to 2021. This is where we had Amazon at during the time of the pandemic and all this. And we hit all the way up to 88.69. We came very close on this position. So on Amazon, we recently added right around here. We actually added to the Amazon position inside our paper trading portfolio. We're going to bump up against this level right here. And I do think it might be time to sell a call against the position in Amazon. So I can't bounce between the paper trading account and that Amazon position. I want to sell something prior to the earnings. And I don't want to be in a covered call position in Amazon during that earnings report. So I'm going to, over in the paper trading portfolio, we had a position in Amazon where we had 1 deep in the money call option. We added another additional deep in the money call option. And the trade, what I'm going to look to do, and I'm going to do this as soon as we get off the show, I'm going to sign back into the paper trading portfolio, is we're going to go out a short time frame, about 16 days here. April 26th is where we're at. Well, we might even actually do the 9-day one. Let's look at the 9-day just to keep it real short, because we do got decent vols in Amazon. We got trading right around 26 vol and $185 price point. 20, the 26th, it looks like that's when the earnings is going to come in, because we jump from implied volatility to 25 to 42. So I want to get this 9 days worth of decay prior to that earnings report. And if we look at the 192.50, we're looking at about a delta of 17 here. We can get about 60, let's call it 67 cents. And we're going to look to sell 2 of these option contracts, hoping that they will expire worthless prior to the week that we have the announcement of earnings in Amazon. So we're a little top heavy. I think it's going to struggle here trying to break out to a new high on Amazon, but it has been a very strong stock. So we're going to look to sell a very short-term trade in Amazon and add 2 call positions to the 192.50 mark going out 9 days prior to that earnings report. All right, so I don't see any questions inside the chat box. So short and sweet this week for Options Guide TV. Come back on Friday, see if we did any adjustments on Thursday for the calendar spread, i.e., or the butterfly that we added to our initial position. And please click subscribe, ring the bell, and hopefully we'll see you this Friday for the next edition of Options Guide TV. Thanks for coming, everyone.
All opinions expressed by Tradier Hub contributors are solely the contributors' opinions and do not reflect the opinions of Tradier nor its affiliates and or subsidiaries. You should not treat any opinion expressed by Hub contributors as a specific inducement to make a particular investment or to follow a particular strategy, but only as an expression of their opinion. The contributors' opinions are based on their own personal research, but neither Tradier nor its affiliates and or subsidiaries warrants its completeness or accuracy, and it should not be relied upon as such. Any trades or positions discussed or referred to by contributors may or may not be actual live trades or positions. Such information is not intended to be financial or investment advice. Tradier Inc. is the parent company of Tradier Brokerage Inc. Tradier Brokerage Inc. and Tradier Inc. are separate entities with their own products and services. Securities products and services are offered through Tradier Brokerage Inc. Tradier Brokerage Inc. is an independent subsidiary of Tradier Inc. All rights reserved. Member FINRA SIPC.